Please know that if you ever come to me to find out which stocks you should buy or sell, dumb move. I'm not going to even pretend to know the answer, because I am not a snake oil salesman. I'm a dumb YouTube guy. But there are people whose job is to get on TV and pretend like they know the future. And one of the silliest has got to be the host of CNBC's Mad Money, Jim Cramer. My mission is simple: to make you money. I'm here to level the playing field for all investors. Right, this is a guy who's known for being so off in his predictions that there's actually an inverse Cramer fund that does the opposite of whatever he recommends. So if he says buy, it sells. If he says sell, it buys. And after what just happened with IBM, the amount of egg on this man's face is extraordinary, even for him. The stock is IBM. I wanted your opinion so I can decide whether I should buy, sell, or hold. I want you to buy the stock. Regular IBM. You buy some now. I think IBM's terrific. It's inexpensive. And Arvind Krishna is doing a fantastic job. Several days later, Wall Street opened Wednesday morning after a day in the green Tuesday. IBM, though, had its worst day ever. Shares tanked. The company lost a quarter of its value. $67 billion in market value just evaporated. It was quite literally the worst single-day drop in the company's 115-year history. And the strange part? IBM's numbers weren't even catastrophic. Revenue was $17.2 billion, actually up about 1%. But it was $660 million below expectations. Software revenue grew 5%, when investors were expecting double-digit growth. Infrastructure revenue fell 7%, and consulting revenue remained flat when analysts expected growth. So yes, the numbers were disappointing, but losing a quarter of your entire market value? That seemed like something much bigger was happening. And this is where the story gets interesting, because the problem may have as much to do with the direction of the entire US economy as it does with IBM. And the main culprit appears to be AI. The AI boom is creating two massive shifts at the same time. First, it's putting pressure on traditional software. AI can now perform many tasks faster, cheaper, and more efficiently. And companies are starting to wonder why they should keep spending huge amounts of money on older software when AI can do some of the same work. But there's another side to the AI boom. Hardware. AI requires enormous amounts of servers, semiconductors, and memory chips. And that's where things get crazy. There are basically two types of memory chips: normal memory and high bandwidth memory, or HBM, which is heavily used in AI systems. And HBM is dramatically more profitable. It can generate several times more revenue per chip. So the biggest memory manufacturers have been shifting production toward HBM. Samsung, Micron, and SK Hynix control the overwhelming majority of global memory production, and much of their high bandwidth capacity is already committed to AI demand. That means supply is struggling to keep up. And when supply is limited while demand explodes, prices go up. Way up. Some forecasts have suggested memory prices could rise dramatically as AI companies continue buying everything they can get their hands on. So imagine you're a company that needs these chips. You know they'll probably become more expensive. What do? You buy them now. And that creates a huge problem for companies like IBM. Because if IBM's customers are spending more of their budgets on expensive AI hardware, they have to find the money somewhere. And that means delaying other purchases, mainframe upgrades, software licenses, consulting contracts. Basically, many of the things IBM was counting on its customers to buy. IBM itself acknowledged that numerous large deals failed to close on the timelines it expected. And that explains why the company's revenue disappointed investors. But there's an even bigger question. Is this temporary, or is it structural? If IBM's customers simply delayed their purchases, because they wanted to buy memory chips first, then IBM could bounce back. Once those customers have the hardware they need, they could return and spend money on IBM's products. But if customers are permanently shifting their budgets away from traditional software and toward AI, that's a much bigger problem. Because then IBM isn't just dealing with one bad quarter, it's dealing with a fundamental change in the economy. And if you're finding this breakdown useful, take a second to hit the like button. It helps more people discover these finance stories. And if you want more videos breaking down what's really happening behind the headlines, make sure you subscribe to the channel. Because IBM may only be the first example. Analysts have warned that this same dynamic could be happening at other companies before their financial results even reveal it. Legacy software companies could find themselves fighting for a smaller piece of corporate budgets while trillions of dollars continue flowing toward AI. And that brings us to the bigger question. Is AI becoming a bubble? Look at what's happening. Companies like SpaceX are reaching enormous valuations. OpenAI and Anthropic are being discussed in the context of going public. AI companies are generating huge amounts of revenue, but they're also spending enormous amounts of money. And investors are pouring capital into almost anything with an AI label attached to it. The bulls say this isn't another dot-com bubble. They argue today's AI companies have real customers, real revenue, and real cash flow. And compared with some of the wild valuations during the late 1990s, many AI companies don't necessarily look insane based on traditional earnings multiples. But the bears see something different. They argue the problem isn't necessarily that the companies have no revenue. The problem is where that revenue and spending are coming from. Circular investments, aggressive capital spending, companies buying AI infrastructure because they believe everyone else will keep buying it too. And if that cycle slows down, the entire system could suddenly look very different. That's the real risk. Because when a bubble eventually breaks, the people who benefit most are often not the ordinary investors. Executives may leave with enormous compensation packages. Founders may become billionaires. Early investors may cash out. But ordinary investors? People with retirement accounts? People whose jobs depend on these companies? They're the ones who can end up holding the bag. And that's why the IBM story matters. It's not really just about IBM. It's about what happens when an entire economy starts moving money from the old system into the new one. Software is changing, hardware demand is exploding, corporate budgets are shifting, and trillions of dollars are chasing AI. Maybe this is the beginning of a massive technological transformation. Maybe it's a bubble. Or maybe it's both. The truth is, nobody knows for sure. And again, I'm not in the business of predicting the future. If I was good at it, I probably wouldn't have a YouTube show. So for now, we're going to have to watch what happens next. Because IBM's collapse may turn out to be nothing more than a temporary shock. Or it could be an early warning sign of something much bigger. And that is the part worth paying attention to. If you enjoyed this breakdown, make sure you subscribe to the channel for more finance and economic stories like this. And I'll see you in the next one.